Take a stadium worker making $45,000 a year and the star athlete on the court making millions. The U.S. tax code treats their wages with the same basic logic, meaning a significant percentage of every paycheck is automatically withheld for the federal government. But the person who signs both of those paychecks lives by a different set of rules. Steve Ballmer, the billionaire owner of the LA Clippers, pays an effective tax rate far lower than his stadium staff. In fact, ProPublica found that in some years, the wealthiest Americans legally report zero taxable income. These strategies exist entirely within the law. There are no secret offshore accounts or illicit maneuvers required. The system is designed to allow these outcomes routinely. The disparity comes down to how the law defines wealth. Everyday citizens are taxed on their income, the money they earn from their labor. But the ultra-wealthy don't rely on a salary. They build their lives around the growing value of assets like stocks, real estate, and companies. To understand how these fortunes remain untouched by the IRS, we have to look past the pay stub and examine the specific maneuvers used to bypass the standard tax rate. The first maneuver centers on how money is earned. In the private equity industry, executives receive carried interest, performance bonuses for managing other people's money. While these are rewards for labor, executives classify them as capital gains instead of employment income. This chart shows the substantial gap created by that one definition. If a bonus is treated as income from work, it's subject to a top effective rate of roughly 53%. By calling it a capital gain, that liability drops to just 28%. The financial industry frequently warns that closing this loophole would cause a mass exodus, with top talent fleeing the country to avoid the higher rates. However, modeling from the Center for the Analysis of Taxation tells a different story. Analysis of de-identified tax data shows these executives are deeply rooted in their communities, with 90% of foreign executives having lived in the UK for over a decade. Researchers estimate the government could raise hundreds of millions without triggering an industry-wide relocation. By successfully lobbying to redefine the nature of work, the highest earners have legally shifted their tax burden onto the shoulders of regular employees. When billionaires do report traditional income, they can often erase the tax bill by purchasing assets that generate multi-million-dollar write-offs. This strategy was pioneered by baseball owner Bill Veeck in the 1940s. He convinced the IRS that player contracts should be treated as depreciating assets. By 2004, the law was expanded to include almost every part of a sports team's value. It works through a process called amortization. If an owner buys a team for $2 billion, they can claim that 90% of that price, things like TV deals and player contracts, will eventually wear out. On paper, they get to claim a $120 million expense every year for 15 years. This creates an outsized phantom loss. Even if the team is profitable and its value is rising, the owner uses this artificial paper loss to cancel out the taxes they would otherwise owe on their broad portfolio of outside investments.
A second shield is the private foundation. The ultra-wealthy donate high-value assets, like art collections or company stock, to their own charities, which allows them to take an immediate, lucrative deduction. While these donations are supposed to benefit the public, IRS enforcement is notoriously lax. Experts note that many donors keep donated artwork in their personal residences or private guest houses, offering virtually no public access while keeping the full tax benefit. Because these assets often remain under the donor's control and are valued as depreciating business equipment despite rising in market price, the tax code essentially subsidizes the acquisition of personal trophies. These sports teams and art collections aren't just investments. They are tools used to zero out a billionaire's civic obligations. If a billionaire manages to report zero income to the IRS, they still have to fund a lifestyle that includes purchases like this. This is the borrow phase of the cycle. Instead of selling stock to get cash, which would trigger a tax, billionaires use their vast holdings as collateral to take out low-interest loans from banks. This works because the IRS does not classify borrowed money as income. A billionaire can access hundreds of millions in liquid cash for spending, and because a loan must be repaid, the cash infusion remains tax-free. This deferral can last for decades, but eventually, the borrower passes away, leaving behind a vast estate and an unpaid capital gains tax liability on those original stocks. At this point, the stepped-up basis rule takes over. The tax value of the asset resets to its current market price at the moment of death. The liability for all the growth that happened during the owner's lifetime is legally erased, allowing heirs to inherit the fortune without paying a cent on those gains. By combining these steps, the ultra-wealthy transform a lifetime of wealth accumulation into a perpetual, untaxed family dynasty. The current American tax system operates according to a precise logic, one that has been carefully engineered over decades to favor the growth of capital over the value of work. But those rules can be changed. Legal scholars have proposed a realization at borrowing rule that would target the core of this tax avoidance cycle. Under this rule, taking a loan against an appreciated asset would be treated as a taxable sale. By removing the liquidity advantage, making the tax cost of a loan identical to the tax cost of selling, the incentive to borrow indefinitely would vanish, ending the primary mechanism of lifetime tax deferral. To address the final loophole, lawmakers have introduced the STEP Act, the Sensible Taxation and Equity Promotion Act. This would close the stepped-up basis loophole by taxing unrealized gains upon inheritance. It protects smaller estates by exempting the first $1 million in gains, but it ensures that enormous fortunes are finally subject to the same income tax that workers pay every year. Ultimately, taxes are just a set of rules. Until those rules treat the growth of wealth with the same weight as the effort of labor, extreme inequality will continue to be the system's primary output.